This past October, Horwath teamed up with Bank Director to conduct our second annual Bank M&A survey to find out what CEOs and directors thought about the state of the M&A market. We thank everyone for their participation. While we have seen improvements since 2011, we are still well below pre-crisis levels. Before 2008, the average deal volume was approximately 260 deals per year. In 2012, the total volume will likely be less than 220 deals, aided by a strong third quarter deal volume. However, 62% of the survey respondents indicated they expect to see less than 200 deals over the next 12 months, so definitely some uncertainty from the respondents. Deal pricing has also increased since 2011, but is still well below the pre-crisis levels, and the volume of FDIC failed bank acquisitions has also slowed significantly, but still provided opportunities for buyers. According to our survey, the number of potential buyers has gone up this year, and almost half of the respondents are hoping to acquire a healthy bank in the next 12 months. At the same time, almost 90% of the respondents have no plans to sell a bank, a branch, a line of business, or a loan portfolio. The main reasons for this disconnect between buyers' desires and sellers' intent can be traced to two primary factors: credit quality and deal price. In our survey, the top two barriers for being able to complete a deal from the buyer's perspective are concerns over credit quality at the target bank and the seller's pricing expectations being too high. These may actually be connected. Friction in pricing expectations may come down to differences in views on the true credit quality of the seller's loan portfolios. Buyers tend to believe that sellers have not fully realized the losses in the portfolio, and sellers tend to believe that buyers are too cynical about problem loans, often loans that they've been working on for a number of months before the buyer comes in and puts an expected loss on each loan within just a few weeks of due diligence. In terms of pricing, I believe that sellers understand that pricing will not be back to pre-crisis levels, but they are also not willing to sell for just any price, regardless of pressures in the marketplace on their business. Pricing was the number one barrier to M&A for both buyers and sellers in 2012. The average price to tangible book value for all deals announced during the year was 117.5%. Almost one-third of the deals were announced with price to tangible book values less than 100%, while slightly more than 5% of deals achieved a price to tangible book value greater than 200%. So while pricing has improved since 2011, it is still well below an abundant level. The new gold standard may be 150% price to tangible book value, as only 19% of the deals announced had higher pricing. Now, in order to achieve the best pricing, the number one imperative is to clean up the loan portfolio. Our survey results indicated this, and information about deal volume shows that credit quality drives deal volume and deal pricing. Being sober about the assessments on long-term workout loans will pay dividends with potential buyers. They will appreciate the candor and may tend to view other loans more favorably because sellers were upfront on the worst loans in the portfolio. For those loans where there are true differences of opinions about credit, sellers should be open to contingent payments or even alternative structures where the bad loans are left behind for the sellers to resolve. If the seller's perspectives on the problem loans are correct, it can create an even higher value for the shareholders if the loans are collected at a higher value than the buyer would anticipate. Around 30% of the respondents want to make an acquisition outside of their core branch banking franchise in the next 12 months, with investment management, insurance brokerage, and residential mortgage origination businesses receiving the most interest. The reasons these businesses are being considered are that banks are looking outside of their core banking for earnings growth through fee income generation. Additionally, most of these businesses are not capital intensive since the assets are not on the balance sheet, unless, of course, the mortgage business is used to generate balance sheet loans. An additional incentive for non-depository acquisitions can include capturing more of the customer wallet share, although in many cases, banks have reported difficulties in achieving true cross-selling opportunities, or diversifying the customer base. In many acquisitions of non-depository businesses, the customers are not likely existing customers, and it can provide additional sources of revenue not captured by core banking. 61% of respondents feel a bank needs more than $500 million in assets to stay competitive in today's market, and 31% feel size isn't a determination of competitive strength. I have been in the banking industry for almost 30 years, and through that time I've seen significant changes in capital guidelines, regulations, competition, and other structural factors. Routinely, I've been asked if there is a minimum asset size a bank needs to stay competitive. In general, my answer is always bigger than you currently are. Yet the industry still finds smaller institutions thriving in their markets. Now, it can be difficult for a small bank, say less than $250 million, to compete in metropolitan markets, but they tend to thrive in smaller markets. With every new regulation, many pundits will put information out about how much burden the regulations impose on banks. It is true that regulatory burdens have increased. However, even with the burdens, banks of all sizes seem to adapt and find ways of complying. Eventually, regulators tend to apply the regulations in a size-appropriate fashion. Obviously, it's too early to see whether this trend will occur with Dodd-Frank and Basel III. In looking at the trailing 12 months earnings levels, it is interesting to see that the average earnings for all size categories of banks are consistent with the industry's earnings. It does appear that bank deal volume will be above 200 deals absent an economic or regulatory surprise. The continued implementation of Dodd-Frank and the ultimate application of Basel III could be more than anticipated, and if that is the case, then these will likely dampen deal enthusiasm, especially Basel III, which will likely require higher levels of capital. FDIC failed bank acquisitions will continue, but at a modest pace. While it is true that the number of problem banks is still high, the FDIC and other regulatory agencies have been working with these institutions, which have led to lower deal volumes. The interest in non-depository institution acquisitions appears to be steady, and banks will be looking for these areas to add to their fee income levels. Finally, an area that should not be overlooked is branch acquisitions. At least 65 branch deals have occurred annually over the last 5 to 7 years, and it does not appear to be declining. For many smaller banks, these branch acquisitions may be the only viable acquisition opportunity available. For additional results from our survey, please visit bankdirector.com or review a full discussion in the first quarter 2013 issue of Bank Director magazine.